I'm Kyle Malnati, your host of the Calibrate Real Estate podcast. At Calibrate, we exist to help people create generational wealth through real estate. My personal mission is to encourage, empower, and educate you by sharing best practices from business leaders that are proven winners. Broadcasting from the Mile High City, thank you for tuning in to a special episode of the Calibrate Real Estate podcast. Before we introduce our guest expert, I'd like to say welcome and thanks to the familiar faces that have joined us on Zoom, or at least those boxes with your name written in there since I can't see your face. Represented on this webinar are clients, multifamily owners, partners that have been an integral part of the growth of Calibrate Real Estate since the company started almost 5 years ago. I know it's hard for me to even believe that this startup that I dreamed about will actually be turning 5 years old this fall. In 2020, Calibrate was proud to represent our clients in 64 successful transactions. At our core, we exist to help people create generational wealth through real estate. That's our mission. I'm proud to announce that Calibrate finished 2020, obviously a goofy year, but finished 2020 with $58 million in change in brokerage of sales and leases, which was $9.1 million higher than our 2019 production. Not too shabby, but that's enough about us. Many of you have actually been to this presentation in person over the years. In the past, this presentation was an event. We hosted a client appreciation party with food, drinks, and great conversation. Our past two events had 80 to 100 people in attendance. We have over 40 RSVP'd and are live with us today. Due to the COVID pandemic, the city and county of Denver guidelines don't allow for group gatherings of that size right now. But the team at Calibrate Real Estate still wanted to do something special where we could provide you with good, interesting, and valuable information. The brokers at Calibrate Real Estate are asked all the time about the direction of the market. And I know I'm dating myself here, but I started my career in the Denver apartment market back in 2004. Wow. And back in 2004, the average price per unit was $58,000 and change. Over the course of the next 5 years of my career, and as the experience that each of you have had, we kind of averaged around $64,000, $63,000 per unit leading into the recession. In 2011, we were at about $70,410 per unit. So in the past 10 years, we have experienced 185% appreciation in the past decade. That's 18% or more appreciation per year, or 1.5% appreciation on your value each month. It's a great reason to own apartment buildings in Denver. The most notable stat is in 2019, we actually eclipsed $200,000 per unit on average for the sale of apartment buildings over 10 units in central Denver. And this past year, we had kind of a goofy year, but lots of sales over 200,000 a unit again. So these statistics are a good reminder to everyone of how blessed we've been by the apartment market in Denver. And we're absolutely thrilled to have an expert with us today. Although the subject of taxes is not always a great subject, it is a necessary thing in our industry, and making sure that we navigate the assessment process as well as the appeal process is really important. So let me introduce our special guest expert, Keith Erffmeyer. Keith has devoted his entire career to the city and county of Denver's assessor's office, actually starting on the bottom rung of the ladder in 1994 as an intern, then progressing to a senior level appraiser, earning a certified general appraiser license. And in 2005, he became the commercial section supervisor. Later was promoted to the role of deputy assessor and chief appraiser. And he's served as the Denver County's assessor since 2014. So I know that people will be either waving or silent clapping, but please join me in welcoming Keith Erffmeyer. Keith, I'll yield the floor to you. Excited to have a discussion about the 2021 revaluation, of Denver County apartments.
Well, thanks, Kyle. I usually don't get much in the way of applause. It's usually, tomatoes or onions or something of that nature, but it's truly a privilege to be here meeting with everybody again. As Kyle went through kind of that recap of the last 15, 17 years, it's very interesting for even us to look back as we see this appreciation that's occurred in the market. Of course, as an assessor's office, we're required to reflect that. So we're gonna talk quite a bit about how we do that. We're gonna talk about when we do what we do. We're gonna talk about how we do what we do quite a bit. Talk about a little bit of what you might expect on your NOV that's going to be coming in about 3 weeks. As I look at the calendar, we're going to talk about how that results in taxes. And we're going to touch on the Gallagher Amendment that was repealed this past November and how that can impact things potentially going forward. And last but not least, what you can do if you feel like your value's not correct. So we're going to unpack all that. I've got, probably about 15 slides or so I'm going to roll through. So I'm planning on just powering through it. If you've got some questions, I think you can probably drop them in the chat. At the end, Kyle and I will try to kind of, tackle those together and even allow for some dialogue if we've got some time. So first thing I want to do is touch on some assessment basics, and which is how, in this case, residential property is valued. So in Colorado, there's something known as a base year concept. What that requires assessors, there's 64 counties, 64 assessors. We are required to appraise every 2 years. Good, bad, whether the market is going up, staying the same, or going down, there's no exceptions to that. We are required to appraise every 2 years. So for this year, the property value that all assessors need to arrive at, which is kind of synonymously known as the actual value, needs to reflect the valuation date of June 30, 2020. That's what the statutes outline for all 64 assessors, so that we're all on the same page as one another, so that there's equity throughout Colorado. In the world of appraisal, there's a valuation date, and that date for this reassessment cycle or base period is June 30, 2020. The period of time known as the base period that we pull our information from is really the preceding 24 months. So the day after the previous base period ends, which is July 1, 2018, is when the new base period begins. That goes all the way through June 30, 2020, and that's the information, the base period of time of information from which we will draw all of the data to value, in this case, residential property. There's an assessment date, which is a little bit different. It's January 1st, and you're like, well, Keith, you just told me June 30th was so important. What's so important about January 1st? And that's where we reflect the condition of the property. So think of it this way. What is the condition of the property as of January 1st? And what would the value have been as of June 30th based on that condition of the property? A good example of that is a property that's being constructed, new construction. As of January 1st, it might be 10% complete, 50% complete, 5% complete, whatever the case may be. And we reflect that condition of the property and the value as of June 30th, 2020. And the same is true for all properties. The other thing that's really important in statute is the concept of using what's known as the market approach, which is that we use sales of similar property during that time frame. We adjust those sales to June 30th. Colorado Constitution requires all residential property be valued exclusively by the market approach. Other property types can be valued using different approaches to value. For residential property, it is the market approach and the market approach only. And just to reinforce, June 30, 2020 is our magical date. This is how that looks graphically. You can see the study sales period in the middle, the 2-year period with the appraisal date of June 30th at the end of that. The blue on here represents that assessors can, if they don't have enough data, they can go back in 6-month increments to grab enough data. We typically do not have that problem in Denver. We've got Kyle did a good job of outlining the sales activity. Some counties struggle to get 5 sales to put together. So it allows them to do that. The area in red is what we call post-base period. We're not supposed to consider anything past June 30, 2020. And this past year-ish, a lot has happened since June 30, 2020. In fact, a lot started even prior to June 30, 2020. So, but we're supposed to have blinders on and not pay attention, with the exception of the assessment date of 1/1/2021. That can be considered, should be considered, as I mentioned previously, the condition of the property, its physical state. So, and as I mentioned, COVID-19 about 80% of the way through that base period struck and really created quite a bit of upheaval. We'll unpack a little bit more about that but I think it hit certain property types much more than it did apartments. So what do? We do something called mass appraisal. If you've ever, I'm sure you've had finance or refinancing on properties. You get what's known as a fee appraisal or a site-specific appraisal to allow for financing or disposal of assets, whatever the case may be. Well, in the assessor's office, we can't do them one at a time. I've got 30 or so very capable appraisers, but I have 226,000 plus taxable properties. We can't do them one at a time. So we have to do something called mass appraisal, which is valuing a group of properties, in this case apartments, as of a given date, that being June 30, 2020. And we use some standard methodology, we use some common data, and we statistically test that. And that's what is outlined for us. This definition comes from the IAAO, which is the International Association of Assessing Officers. It's a very unique, special group that I belong to. And this is what the IAAO outlines. So we're going to unpack a little bit more about what is this standard methodology, what is this common data idea, and how do you statistically test that. First thing we do, we verify all the property transactions in that 2-year period. It is incredibly important if you're going to value property and model property to have good data. If you don't have good data, it will reveal itself at some point along the way. So what my staff does, they verify these transactions. We qualify what we consider the arm's length transaction, which is a transaction between unrelated parties. No one's under duress. It's, the buyer might have wanted to get a little bit better price. The seller might have wanted to get a little bit more money, but they both transacted at what they felt was, in this case, market value. So first of all, we want to make sure it's arm's length. Second of all, we want to make sure our database is right. So we do that. We verify the square footage, whether the property's been remodeled, bedroom counts, bath counts, if it's distressed, if there's negative external factors. Sometimes a property will have something built across the street that blocks its view, or a new, access point that creates more traffic or something of that. So things don't stay the same forever. They change over time, and we want to make sure that our database reflects all that. So where do we get this information from? We get it from CoStar, from RE Colorado. Apartment Insights is a really good resource for us, especially with 50+ unit properties. Transfer declarations are the little form that you fill out at the closing table that most people have no idea what they are. That helps inform us of certain things. We try to personally interview people when we can. We send letters, known as sales verification letters. We have historical records, permits. So we do a lot of verification. Most people are probably familiar with Zillow. I don't believe Zillow verifies any of the data. I think they simply use public data. They dump it into a big kind of algorithm that's very proprietary to them, and it spits out whatever it spits out. That's generally okay if you're appraising in Highlands Ranch or somewhere where there's very similar houses and most transactions are arm's length. We don't take that risk, quite frankly. We want to get the value much more accurate than I think Zillow can allow for. So this is a very important step in that particular process. This might be an interesting slide. This is the number of sales, the verified sales, good sales that we used. The top line is what we call Model 1. That's generally 4 units or less. The purplish line is Model 2, which are kind of more Capitol Hill area, mid-rise, 5+ units, sometimes row style. And then the green line is our Model 3, which are generally our planned building groups, more of a suburban style, as well as a lot of newer high rises, say around the ballpark neighborhood or something like that. So even by quarter, the sales bounce around quite a bit. I had this graph by month, and they bounced around even more. So to smooth it out, I did it by quarter. I think the takeaway on here is that other than Model 1, I think in the last quarter, post-COVID, still had some pretty healthy numbers of sales. But I think for both of the other 2 models, the lowest number, not price, but the lowest volume of sales was in that quarter. So it really created for assessors, quite honestly, a concern. Were we going to have enough data that tell us where the market was as of June 30th? This is especially true, honestly, for commercial property. Commercial property transactions virtually stopped altogether. But as you can see here, even though they're low, the concern kind of didn't manifest itself quite like we thought it might for apartments. We still feel like we have enough data to tell us what's going on as of June 30th. So what do we do with all this data? We develop what we call valuation models. Those models, really math models, one could consider it maybe even an algorithm. Those are meant to represent the market. We're trying to replicate what buyers and sellers are doing in the market and apply that to a large group or universe of properties. So we use both quantitative and qualitative property characteristics, quantitative being what you can measure, square footage, bedrooms, baths, basement areas, those kind of things. Qualitative being more subjective, grade, what we call obsolescence factors or negative factors, what neighborhoods, how we break the neighborhoods apart, even the mere fact that we separate into models 1, 2, and 3 to do this process is somewhat qualitative. So you might ask, well, how do you know how to grade things or apply obsolescence? And quite honestly, that comes with a lot of experience from our appraisal staff, from viewing transactions, talking to people. It also comes from, say, like an Apartment Insights, which has property grade information on it. We also get it from historical interactions with property owners as to, say, conditional concerns or problems with their property. So as properties are appealed, even when they sell, we dialogue with people, and that can inform us something about the property that can carry forward year to year to year until that's either corrected, or maybe it's something that's not correctable and it just has to be part of that record for years into the future. So we use all this data to develop these different models. As I mentioned earlier, we stratify them into 3 different groups. We feel like this gives us the best separation, but still keeps some homogeneity within these groups. We could, if we did want to separate these into more groups, we could, but then your sales within each group goes down and your models become less reliable. So we found over the years to be the best way to really separate these groups. There's a number of different reasons for that, but we essentially have model 1, 2, and 3, and I'm going to touch on that a little bit more here in a minute. As we develop these models, first we stratify them, then we have to trend, what we call time trend, to the data valuation. And there's very specific statistical techniques that allow us to do that. In the past, as Kyle described, 1.5% per month was not unusual for us for several base periods. This time around, that, as you can imagine, was not the case. We had more or less insignificant upward time trends particularly for models 1 and 3. We did have a time trend for model 2, just kind of, I would say, very gentle upward time trend that we applied. So, but the first thing we need to do is take all the sales that occurred earlier in the period, and we need to trend them for time as if it had sold as of June 30th. So that's the first thing to explain. And then we do, this might get a little geeky, we do something called multiple regression analysis, and I'm going to unpack that more here in a minute. And we review the results of that, and we work the outliers. So let me unpack that a little bit more. As we do this multiple regression analysis, it's a technique that we use to analyze data to predict a variable, in this case, market value from the known value of other variables. So what we're doing is we're dumping all of these sales that I mentioned that we verified. We're doing it based on 3 different models that I mentioned, and we're allowing our statistical software really to perform something called multiple regression analysis, which is basically geeky math, really, to tell us how much each component of a property is adding or subtracting to that value. So its location, its grade, the average unit size, the average bedrooms per unit, the average baths per unit. All of this information, it will calculate what it thinks is the best fit to get the most accurate value for, say, 100 sales in a data set. And we will continue to do this and review this and try and zero in to get the best fit that we possibly can on these models. Those coefficients, so for example, what you might say, well, what the heck is a coefficient? So a coefficient might be, it adds, let's say an extra bathroom in an apartment unit adds $5,000 to the value of that. Let's say 1 square foot in Congress Park adds $100 per unit over one that doesn't have that square foot. So it does this, try to get to the best fit it possibly can. Every once in a while, some coefficients will spit out that are just not logical, like an additional bathroom subtracting from value. Typically, it doesn't happen very often. In fact, rarely. Hopefully, if the data is good, it never happens. But we can constrain those and say we don't think that makes any sense if it's not logical. And we do this process over and over and over again. So as the coefficients are developed, we review what are known as outliers, which are properties that aren't fitting the model very well. And we start asking ourselves, well, why is that? Why isn't this fitting? I'll give you an example for residential property is sometimes we'll have a house that has a swimming pool in it, and that's part of our data. And if you've been around Colorado long enough, there's not a lot of houses with swimming pools around here. We're not exactly Phoenix or Palm Springs, but there are some. And sometimes because the model is really trying to hit that unique property so precisely, it causes noise elsewhere within the model. So same thing's true of apartments. If we have a particularly unique or atypical apartment within the model, sometimes the model will try and stretch itself to get that one just right, and it does it at the expense of the others. So we have to keep reviewing these outliers, keep reviewing the properties and making sure that our information is as correct as it possibly can. It just allows us to kind of slowly but surely zero in on a final model. So how do we know if we're good or not? How do we test that? So we do have some statistical testing that we do. We're audited annually. Actually, by the State Board of Equalization, authorizes an independent auditor to audit all 64 counties to make sure our values are accurate and that they're not disuniform, that they're similar. So if a sold property is the same as an unsold property in every way, shape, and form, that those should be valued the same, and that one shouldn't be penalized just because it's sold. So there's two ways to do that. One is what's known as a median sales ratio, which is kind of our middle sales ratio. And the other is a coefficient of dispersion, which tells us how dispersed our values are. I won't tell you what those measures are, but know that the state is concerned with making sure the values are at the appropriate level and that they're very tight in terms of their dispersion. So takeaway there is that we're audited and we're not just going willy-nilly doing whatever we want. This might look familiar to some of you if you've received an NOV from us in the past. This is known as we call it a comp sheet, and there will be a comp sheet included in most of your notices of valuation that are coming out. Oops, I didn't mean to do that. Most of your notices that are going out, I'm not going to spend a huge amount of time on here, but what we do is on the far left would be your property, the subject parcel. There's, in this case, 5 comparables that we use from the market. These are actual sales. So this is kind of a little bit more fee appraisal-ish, where we're comparing those particular sales to yours, and we're making then some adjustments, which are down at the bottom. And it's very difficult to explain without really being in person. But I think the takeaway here is that you will see some sales that are on your NOV that we use to try and zero in on your property's value. So I would suggest that you review those and kind of look at those. You can see some familiar terms in here, such as the adjusted sale per unit, the adjusted sale per square foot. And if you have questions about that, or if you think that there's better sales available, you certainly have the opportunity to redirect us to those.
Keith, I'm going to chime in briefly. If you go back to that slide real quick, something that happens from a practical standpoint in the month of May when clients will call us and say, can you help pull comps together? We feel like maybe the valuation is not quite what we were expecting. One of the things to look at the top of this page, and I know it's probably a little bit harder to see in person, but or on the screen here, but you'll certainly see it in person when you receive this in the mail. The neighborhood cluster and the neighborhood group often tend to be something that is a high area of emphasis with the assessor's office, something that we talk about a lot. The other thing to think about very obviously are bathroom counts, bedroom counts, and making sure that this data is correct. There are plenty of times where we'll sit down in an appeal meeting and identify that something that was in the multiple regression analysis that's pulling data out is pulling the wrong data because this form just happens to have something that has changed or is no longer valid. So just wanted to mention that as you're looking at that, this is probably the best area to isolate some inconsistencies that may make the data spit out the wrong way.
Yep. Yeah. And the neighborhood cluster, neighborhood group, another way to translate that is location, location, location. So it's a huge driver behind the values, as you can probably imagine. And Kyle's exactly right. There's going to be a pointer at the end on checking your data. So we'll get to that one. So we're actually done with our values, as you can probably imagine. We need to send notices by May 1st. So it's actually at the printer right now. So I can give you a sneak peek at what really happened as far as median changes are concerned. No one's actually seen this yet. I'm not even sure my internal staff knows this. So
it's a big reveal. Here we go.
Right. So this is citywide, and I talk in medians, and sometimes I do that very hesitantly because if you have a house that went up 8.4% instead of the 8.3% median, sometimes someone will let us know that very detail. But take it for what it's worth. These are medians. Single family, condos, and row houses were both in the, say, 5 to 8% increase. Commercial property was very diverse, really, in terms of its change. CBD and low dose, you might imagine, has been suffering quite a bit. This is the first time I can remember decreasing values downtown in probably a decade, or possibly even longer. Hotels, motels really suffered quite a bit, as I'm sure one could assume. Retail, small offices kind of held steady, and interestingly, warehouses seem to have been, no pun intended, immune to this whole thing, because they've fared very well. I think the thing to remember about these numbers, and I'm going to show you the apartments here in a second, is keep in mind that these changes reflect roughly 21 months of appreciation, followed by 3 months of post-COVID, who knows what, right? Depending on the property type. In some cases, that still could be appreciation. In some cases, it might be flat. And in some cases, and I would argue for a hotel motel, that was followed by 3 months of falling off the proverbial cliff. So one might ask, well, why aren't hotels, motels even less, or going down even more? It's because they did experience quite a bit of appreciation prior to the downturn. So this is an aggregate view of really 24 months. So going back to the three models, the 1 to 4 units showed about a 9% increase. The model 2s that I mentioned showed about a 7% increase. And our largest group, our most valuable properties, are in the 10.5%. So they're very consistent with one another. They're fairly consistent with what happened with single unit properties. It's been a while since we've had this amount of consistency really in the residential sector. But that's the result. So I'm guessing most of the people on this call probably fall into the Model 2 category. That would be my expectation. If you get anything other than a 7.2% increase, that means you're not at the median. It doesn't mean we did something wrong, but just kind of keep that in mind. So how do you turn all this stuff into taxes? So we send a value. It's known as the actual value. I'm going to use $1 million as examples for both residential and non-residential. That's multiplied by what's known as an assessment ratio. That's in statute, set in statute. It used to root itself in the Constitution. I'll I'll get to that in a minute, but those rates are currently in statute. Those are the most recent rates adopted by the General Assembly. That results in what we call the assessed value. So sometimes we talk about assessed value as if it were the actual value. Technically, the assessed value is after you apply the ratio. And then there's a mill levy setting process that happens at the very end of the year. The 0.074195 is the most recent base levy for Denver from 2020. And that results in the taxes. It's a pretty straightforward calculation once you know what it is. One of the takeaways here might be for non-residential property that the taxes are roughly 4 times dollar for dollar what it is for residential property. That's a product of the 29% versus the 7.15%. Well, that's what Gallagher was all about. So it was repealed by voters in 2020. As a result of that repeal, that 7.15 ratio is no longer required to be calculated and adjusted downward. It is set, I don't want to say frozen, it is set until something different happens. So the something different will not be Gallagher. The something different could be a vote of the people to lower it, a vote of the people to lower 29%. Right now it is what it is, and it will stay at 7.15, particularly well for both 7.15 for residential, 29% for non-residential, unless something different happens. The General Assembly theoretically could lower it of their own decision. I would find that a little bit surprising, just given the political climate. One thing is for sure is neither can be increased without a vote of the people. That is the only absolute here. They could be decreased by the vote of the people. They could also be decreased by the General Assembly, but they cannot be increased unless the people of Colorado vote for that. So that 7.15 is what had been dropping all these years, and it will not be adjusted. Another way to translate all that is when you get your value, if it does go up to 7.2%, the assessment ratio is not going to go down to offset that. It's going to stay at 7.15. So the mill levy, which we'll talk about here momentarily, still would need to be adjusted, but you might feel, how do I say this, a fuller effect of the increase than you had in years past because the residential rate is not dropping. So in terms of a timeline, I'll unpack this pretty quickly. We talked about the 24-month base period. We talked about June 30th is where the appraisal conditions are. We talked about January 1st being the physical status of the property. We're going to send NOVs here in about 3 weeks. Those will be sent to all property owners. There is a month long window through June 1st to appeal that to your county assessor, whether that's Denver or elsewhere. We have until mid-August, August 16th, to work all those. And I'd be lying if I didn't tell you I expect a lot of them, particularly from commercial property owners this time around. We send an NOD no later than August 16th, and that gives a property owner appellant another month to appeal to what's known as the County Board of Equalization. The first level, the assessor, my staff simply reviews and tries to correct as much stuff as we feel needs correcting. There's really no oversight there. The second level is the CBOE. There's hearing officers that sit and hear these cases. They're independent. They're hired. We pay for them, but there are appraisers out there in the fee world that come in and listen to both sides and render a recommendation. We have to send out the results of that no later than November 1st. And then if still, well, first of all, there's a certification. That's where the mill levy is set. And I'll talk about that briefly here in a moment. You can still appeal to the state level if you're not satisfied with the CBOE. And I know Kyle's represented some property owners in that endeavor before. Sometimes, quite frankly, it just takes time to get on the same page as some of these appeals. And sometimes there's just a disagreement on it. So that goes well into the future.
Well, and if I may interject there just for a moment, Keith, this process is very well defined and is literally date and time stamped a lot of the people will have us go as an agent of record, and we'll be up the night of, sort of like an accountant might be heading into tax day, where you're cranking these things out all the way until the deadline. But I would suggest you go through the process, because it opens the door for a discussion, and sometimes it goes one or two layers into the process before you have something happen. But the assessor's office is always reasonable. I actually chuckle when Keith and some of his staff will remind me, they're like, look, we don't get bonused because your taxes are higher. We don't like have any commission that we get from this. We have no reason to want this higher, and we actually want to get it right. And they're very sincere about wanting to have a discussion. So it is a part of the process that's important. And then in the slide before that, we don't need to go back to it, but just as a reminder, the apartment category is under the residential category, which is one of the biggest blessings that we have in the multifamily market, is that you have the ability to rent apartment units out, but not be taxed like commercial office buildings or retail. So we are very much residential, and that is a category and a distinction that's very helpful for our business.
Yeah, and maybe just touching on that a little bit, you know, Dennis Gallagher, the namesake of the Gallagher Amendment, will tell you that it did exactly what it was designed to do, which is to keep residential taxes, prices, costs of living down. And it was successful in doing that for residential property owners and apartment dwellers as well. I can only imagine what the taxes would be if not for that, given the increase in the market that's occurred. Colorado is it's the third lowest last time I checked in the nation in terms of property tax rate, not necessarily property taxes, because our values are pretty up there, but in terms of property tax rate, last time I checked, we were third lowest in the nation. So, which is quite honestly, I think one of the big reasons why the ballot was successful to kind of end that. So, so if you do want to participate in the appeal process, the first thing I would say is make sure you know, well, how do I say this? You don't have to. If the value is good and you think we've done the job right, you don't need to, you know, we'll take silence as a pat on the back, so to speak. However, if you aren't certain or you think there is a problem, here's some suggestions. Number one is don't consider the current market. I couldn't even tell you if the current market's better, same as, or worse, because we don't look past June 30th. Do remember that date of value, and also remember that assessment date. If your property was undergoing renovations or there were some big issues or something that we don't know about as of January 1st, that's important to us. But think about what could you or would you have sold your property for as of June 30th last year. Don't protest the taxes. The most common appeal that we get says taxes too high. That's it. Doesn't help us. It's all about the value. That's really what we do. We don't set the mill levy. We don't even set those assessment ratios that I mentioned. We determine the value. And Kyle's right. We don't have a vested interest in them being high or low, because the mill levy process that comes at the end of all this it's set after the aggregate values are added up. So if values diminish, the mill levy is set higher. Values stay high, the mill levy is lower. So it all comes out even in the end. A couple other suggestions. Don't consider the rate of increase or decrease. Sometimes things can just happen in these models where yours might go up more than the median or less than the median or something like that. As Kyle mentioned, review the property characteristics, and I'm sure Kyle knows enough about these things, and his staff, I think they've looked at enough of them over the years that they could probably glance at these pretty quickly and tell something's off as far as property characteristics are concerned, especially as it relates to the model, the area, the assignment, that kind of thing. And similarly, just saying the value is too high doesn't help us a lot. Any evidence, I often tell people, you got the NOV, you saw the value, and you thought it was too high. Why? First thing, top of your head, why is that? Why is it too high? Is it something that we're not recognizing? Is there something external to the property that we don't know about? Are there conditional issues? Anything that you can tell us or help us understand about the property that we don't know can help if you're decide to protest. So last thing, I kind of alluded to some of this earlier. And this is as much as what the assessor doesn't do as what we do. So we do this huge valuation effort, send out the notices, work through an appeal process. At the end of all that, we certify, which means we add up all the aggregate value in all the taxing districts, and we send to all the taxing authorities, Denver Public Schools being an example, how much aggregate taxable value they have in their district. And we have to do that no later than December 10th. Within 5 days, they need to use that information. They have certain guidelines, TABOR, for example, voter approved measures being another example, that they use that value, aggregate value, to help. It is kind of a plug and play, really helps them determine where they set these mill levies. There are guidelines so that taxing authorities can't just go willy-nilly setting mill levies wherever they want. There's voter approved measures, there's statutory restrictions, there's a number of different things. And then all of those taxing authorities set their mill levy, they calculate their mill levy, they report it back to us, and then we just kind of enter in what they told us. We don't influence it, we don't go to their board meetings, we don't have anything to do with it. So to reinforce, the assessor set the value, now the General Assembly really, then maybe the voters set that assessment ratio. And then the various taxing authorities that are often voter approved to be on the board to set those mill levies, such as city council, set those mill rates. And those tax bills are then delivered in January. And that's when you get your first tax bill. Maybe one more little tidbit here. In Denver County, 65% or so of the property taxes go to Denver Public Schools. So a full 2/3 of it. We represent dozens of different taxing authorities in this process. They depend on us to get the value correct. And then they set the mill levy and kind of collect their share from all these property tax bills that are paid in the subsequent year. So that was a lot. I think I did pretty well. That is my email and my work phone. As you can tell, I'm not at work much, but I do get the messages. So if you have a question that you would like to direct at me rather than Kyle, that's my direct number to my desk on the 1 day a week that I'm actually there, but it emails me if I get a voicemail. So feel free to email me, feel free to call me if you have questions, and maybe Kyle, I'll turn it back over to you and figure out how to stop sharing this as I do that.
Thank you, Keith. Yeah, now we're all excited to receive our assessments in the mail, and in May that'll happen. I know that there's a lot of people on this Zoom that have been a part of this process before with me. Just to sort of go back for those that don't know the process, it happens every other year. It's always the odd year. 2 years ago, we were at our company filling out over 50 written reports. And the majority of those reports in the first period of that assessment calendar, at least in my experience, it's not every single one, but most of those get rejected. And then there's a reissue to actually take it to the Board of Equalization. And that is where I have found that it's the most successful. It's where you end up sort of sifting through all the different reports and appeals that are maybe not as well grounded, or someone wasn't really serious about it. And as a fee-based service, I started doing this over a dozen years. We have over 90% of the appeals that we take to the CBOE that actually result in a decrease in valuation. There's nothing about the process that is under the table or anything. It's all part of the normal process. But what I have found is that if you actually hire someone that can write up a good write-up for you, go through the process, try not to get personally involved in it or get agitated or emotional about it. If you can kind of approach it from a statistical standpoint with someone that's experienced, it generally does result in some sort of value reduction, because there are nuances to the data, and many of the people that are on our Zoom presentation today know that. So it is a reminder that at Calibrate, we work on this process as a fee-based service. We do have an opportunity for brief questions right now, and I would encourage you to actually drop those in the chat at the bottom of your screen if you'd like to do that. My phone will be ringing off the hook. It always does every May in the odd year, and we've gotten to a point now where we've got several clients that do this on the regular that I'm expecting their call. We're actually going to have to limit the amount that we do, because we've got to really treat it as serious cases. And so it will be a fee-based service again. It will be priority based on, did you work with us 2 years ago? And are you on this Zoom presentation? So both of those things sort of get you the early admission or the pre-release. And then towards the end of the month, we'll do what we can to help everybody out. But I know Keith's staff is most importantly trying to make sure that the data is right and to make sure that it's a fair and balanced measure. So I appreciate Keith. It's a big deal for him to be on our podcast today. And briefly, we'll open it up. If I don't see any chat questions coming up here in a minute or two, we'll end our presentation. I do see one from Mike. Mike asks, can the assessor's office increase the value after the initial valuation? I have an answer based on personal experience, but I'll let you go, Keith, first.
We can. It's rather unusual that we would do that. We've actually had people ask us to increase, believe it or not. That happened more in the recession time when I think particularly homeowners were real emotional about seeing their property value decrease and didn't like that and asked us, but we would even tell them no. But it would take a pretty glaring omission, I think, on our part to actually increase it. So it's definitely not encouraged. So it happens extremely rarely, if ever, particularly for apartment properties. Kyle?
In 50 files, I had one for the very first time in over a decade happen in 2019. And it was handled very well. The staff, appraiser on Keith's staff in that particular case said to me, hey, this is what we're seeing. And you filed a couple of reports here, and we're just not sure that you're understanding that we think this valuation is fair. And as we look at it, when we actually sat down with the impartial third-party appraiser, the appraiser ruled to have it increased. The staff appraiser called me back from the assessor's office and said, look, I've seen what's happened here. We're happy to go back to the original valuation before all of these were filed, if you're willing to do that. And we happily acquiesced and dropped our case. But that was 1 out of 50. And that's probably 1 out of, I could probably say 500 or 600 that I've done over the course of a dozen years. We've got some other questions, lots of kudos and thanks, Keith, and great presentation. Bill Matthews, hello, Bill, asks, do we have access to the audit of the process? That I don't know, but what I do want to share before Keith answers is that you will have access to this presentation. You'll have access to both the slides as well as the audio. It'll be released on our podcast this Friday, and you'll receive an email so that you can either listen on Apple Podcasts or you can listen or watch on YouTube. And then we'll also have a tax book that we put together with all the apartments over 10 units, and we've done that every other year. But let's go into Bill's question about how the state's audit of the process works.
So I don't have it on my website. Honestly, it's really kind of high-level geeky graphs and charts and stuff, but I'd be happy to send the most recent state audit report for Denver County to Kyle, who can probably get it to you, Bill, if you're interested in looking at it. This is actually the questionnaire I have to give to the auditor for this year. So the most recent audit was for 2020. They have not yet gotten all of this data because we're just finishing this up. It'll take them probably through September to audit all 64 counties for this year. So, but I could certainly send the most recent report to Kyle, and then he can pass it along. And then while I'm looking at the chat, there is an email address a little higher from one of my staff. I think it's the second comment down. So if you want to email Kim Lust instead of myself, Kimberly Lust, her name is in there. So Kyle, I'll try and get that to you to get over to Bill.
Thanks, Keith. And that's a great reminder that the assessor's office isn't here to hide. Again, they're not trying to do anything other than just get the data right. You'll often get contacted by the assessor's office when they have a question about one of your sales or purchases, if that's valid. I know I do as a broker during this process. So be willing to help out. That it always helps the process and gets the data better. So don't be hiding, feeling like you're getting served by a process server or something for some sort of lawsuit. It's not like that. If they contact you, it's usually to clarify something. And again, like I said, the majority of these that go into the fall after we get through the first initial appeal request, they do end up resulting in some sort of change of value, which is good. Kim asks, how do you qualify the criteria for the math models? And this will start to get over my head. I got a degree in finance, but I'm not a statistics person. So if a simplex math algorithm is used, what are the conditions stated? Do you know what that is, Keith?
Yeah, good question. I'll try to interpret. We use what's known as linear regression, if that makes sense. So I see Kim nodding her head. So we use linear regression to develop our models, and there's a constant and all that kind of stuff. So I would say if you want to kind of really peel that onion quite a bit, you could contact either myself or Kimberly Lust, that's also in here, and we could talk models with you for a long time.
Wonderful. So yeah, I would say let's get you in touch with Keith and Kimberly Lust. Any final questions? Let me just check the chat one more time here. I think we're at an end. I always like to end our podcast on time or early whenever we can. So I think this is a great stopping point. Keith is a valuable resource, has been very kind to our company. And so I know that while you might not be able to hear the applause, there's lots of people waving, saying thank you in the chat. And Keith, this has been a wonderful opportunity. We look forward to the conversation. We really do, sincerely. Any conversations that my group has with the assessor's office are kind, polite, informative. Everybody just wants to do the right thing and get the data correct. So I would encourage you to contact me, and we'll be sending out a form for what the process might look like if you've got an apartment building and you want to go through the appeal process. And as I think about ending every podcast, well, we do have a podcast on Apple iTunes and Apple Podcasts that is over 170 episodes. We launch it every Friday. I'm the host and I interview people in the real estate space. Sometimes it's relevant for people in the multifamily industry. Sometimes it's more brokerage focused, but we certainly have a lot of fun, and I appreciate anybody that's downloaded that. Apple Podcasts is the main area of emphasis, but we do have it on YouTube. And thank you so much for everybody that's been on that. And as I love to say, for Keith Erffmeyer and the rest of the staff at Calibrate Real Estate, we will see you around the neighborhood. Thanks, everybody. Have a good day.